Okay, good evening, traders, or people who want to be traders. I wanted to walk through some of the things that I would do um, to set up my charts. Also, and kind of show people that, contrary to popular belief, the market is not random, that we can see patterns in the market. If you look at the charts the right way, they kind of stand out. Um, I know that this is a 1 minute chart of the E-mini S&P 500, also known as the ES. Um, this is the old contract, ESE6. So we're rolling over tomorrow. So you'll sometimes see a little notification flash up on the screen. Symbol needs rollover. So we can just safely ignore that one. Since this is just for demonstration purposes, I wanted to show you a chart. Here's a typical chart. You can see ups and downs, and God, where's the market going? It goes up a little bit, it goes down a little bit, it goes up here, it goes down here. Um, and I can well understand that people think the market's random. I'll shrink this up just a little bit, and you can tell here's where market open was about 9:30. The cash market open was about 9:30 this morning, which was right in here. And from there, it goes up, it goes down, it fiddles around. It looks pretty random. And I can understand if somebody looks at that chart from that perspective. It looks random. And this is a 1 minute chart. Now, even if we go to a 5 minute chart, it still looks, pretty random. Here was midnight. Let's see. There we are, 9:30. All right, there's the 9:30 open. It's still, really choppy and up and down, and looks weird, and all that kind of stuff. Let me turn that off. I'm not ready for that yet. Okay. It still looks pretty weird. Right now, the market. Right now, you can see the market's trending down. But it's just really, kind of weird. Even on a 15-minute chart, it looks pretty weirdly random, and let me shrink. I'll just leave this. Each tick of this is 1 point, which is 4 ticks on the ES, and you can see that for 12.8. It's a little bit clearer, but still, I mean, how do you trade that kind of weird stuff up and down like that? Looks pretty random to me, and it probably looks pretty random to most people. Well, let's see if we can make a little bit of sense out of that. First thing we can do is I will put on the charts, I will put delineators. Well, let me go back to let's just go back to a 5 minute chart here. Let me put some delineators on to show you when the market's opening and closing, and when different segments of the market and different sessions start and end. I've got a little study for that called Move Times. Poof, here we go. This gives a little more structure to the market. Here's midnight. Here's when midnight starts in New York. All my chart times, by the way, are you'll notice those chart times are New York. So it's 9 o'clock in New York. Here's the New York bond market opens at 8 o'clock. 8:30. Usually we've got news that hits the wire one way or the other, and then here's the cash market open at 9:30, and then all the way to 4:15 when the market closes. The cash market, the New York Stock Exchange is open from 9:30 to 4 o'clock, 4 p.m. every day, New York time. So you hear the bell, and you'll see a little more activity after 4:15, and then everything kind of stops at 4:15. So the reason why I put that on my chart is that you'll see markets. You'll see the market when the bond market, or right before the bond market opens. You can see that long bar right there where before the bond market opened. We saw a move, and that was at 7:45 this morning. Different open and close times, you'll see the markets move, and when London market opens, London high, London low, European close is at 11:30 in the morning. I don't have that marked on the chart, but I usually have an alarm that goes off, and it tells me. And I'll talk about here's the 25-minute open range high and low, and then the 1 hour open range high and low. Generally speaking, there's a lot of people that will not trade the first 25 minutes or the first hour of the market because of the volatility, and they're waiting for a breakout move between the 1 hour, the 25-minute high and low, to basically figure, okay, when do I want to get into a trade? Today, you can see the market broke to the upside after the 1 hour high. So, people were waiting. People were waiting to do anything would not have gotten in until the afternoon session here, and then ridden it up this way. So that's one trading strategy. There's literally thousands and thousands of trading strategies. I tend to look at the market from midnight, simply because that's when the algos reset themselves at midnight. The second thing I will do when I'm setting up these charts, I will set these up, and this is the ES, so it's a little bit differently. I'll set this up with something called Flex Renko bars, which shows price action quite a bit better, and I'll show you these here right now. I've got buttons up here at the top that will let me change the time frames on the chart, like from 1 minute, 5 minute, 15 minute. And say, for example, an hour chart, you'll see that the price action, the market looks completely different on an hourly chart as opposed to a 1 minute chart or 5 minute chart. So let me go to a 5 minute. There's my 5 minute chart, and you'll see choppy, looks pretty random to me. Let me put on my 5-tick Renko bars, and you'll see that it puts quite a bit more structure. See, now you'll see a bit more structure onto the market. So there's a little more. You could go up to, like, say, for example, a 6 if you wanted to. If you like or even a 10-tick. If you like those better, if you like those bars better, or you can even go to a 10-tick, which smooths out price action even more. Which, the problem is it doesn't give you it doesn't really give you a place to get in and get out. So for the ES, I kind of like the 5-tick rollover, or the 5-tick Flex Renko bars, because it gives you enough space that you can see what's going on in the market. It kind of spreads stuff out a little bit more. You see, after the market closed, and it came down and it came back up. Okay, so that gives me, from midnight, that gives me a little bit better picture on what's kind of going on in the market. A lot of chop here, a lot of choppy chop down. You'll see it's trending. The whole trend of the market's down, and then at this point it starts trending up, and then it trends down a little bit, and then trends up, and then down and up. That's fairly typical of the market. You'll have pullbacks, you'll have retracements, you'll have trend moves. We had a really nice trend move yesterday, so today is kind of a pretty nice day to look at this and try to make some sense out of it. So the next thing I will do is I want to put I'll put an automatic trend line on here, and that is one of the main tools that I will use. And what that does is that gives you, it'll put automatic trend lines on the chart to where you can look at that and say, okay, where's the market going? So you can see here, the bottom automatic trend line is pointing up, the top one's trending down, which, looking at this chart, my experience says that right now we're in a channel and we're moving up. We came down to this point and then we're moving back up. So if I was going to, say, for example, I was going to get into a trade, just looking at this chart, people would say, well, where would you get into a trade? I would tend to wait until price action came back down here, back down to that automatic trend line, just, off the top of my head, to take a look at that. Ultimately, what we're gonna do is we're gonna make the chart look like this, where you can see a lot clearer what's going on. So there's my bear chart. I will put on. Oh, sorry. I've got another one up here. I'm going to put in clear method, what's called a clear method trend line. What's nice for that is that you'll see these little trend markers. See the cyan and magenta. I found those extremely handy for generating moves in the market, where to get in, where to get out, type of thing. And you have to be careful because, say for example, the cyan lines would indicate the price action would move up. The magenta would mean price action would move down. Well, looking at this price, looking at this chart, some of these signals, some of these bars would work out. Like, say for example, this one will work out for a little bit, just down to the 25-minute open range low, and that's where I was established after the open. This one worked out because price action went up and then immediately came all the way back down. So it would have probably taken out your stop right here if you had a stop loss set. This one worked out a little bit better, and I'll explain why. This might not have worked out. I mean, you've got a trend, you've got a little bit of a trend move down here, and you can see that, but it was kind of hard to tell why did this move out. Sometimes the market will do things that doesn't make any sense, and it's related to, or apparent sense, and sometimes that's related to time in the market. Sometimes that's related to news. You'll have a farm report or a unemployment report come out, or somebody will speak. One of the major Fed players will speak, and that will sometimes move the market. A lot of this is buyers and sellers, and it's a continual balance between buyers and sellers on perceived value. It's all about perception of value in the market on all the stocks and in the indices. Like the S&P 500 is the 500 top 500 corporate stocks in America. So there's a lot of people in this market, a lot of people playing it. Okay, the next thing that I would do is I would put on a moving average. And I don't want to put just any moving average on. I will put a moving average that the market respects in a lot of cases. In a lot of markets, it's pretty much universal. It's called the 89 EMA. So I will put one on here. Come down here and say moving average exponential. I want to add this guy. So I'm going to set this guy up for 89 EMA. And I want to color this guy. I'll color him here. I'll say 89 EMA. I want to put a name label on it. I want to set it up on the right hand side of the screen. Okay. So, poof. All of a sudden, now the market's starting to make a little bit more sense. You'll notice on the 89 EMA, when price action is above the 89 EMA, and the 89 EMA is trending up, the market tends to trend up, and the market will tend to respect that 89 EMA until it doesn't, and we'll get into that. I'll get into that in a second. Again, the market, it was a little bit difficult to trade today because the market's so up and down and up and down, and you can see where the 89 EMA kind of flattened out here, and this was about 2 o'clock. And this stuff was, unless you're trying to scalp for just a few ticks, it was very difficult to trade this stuff, simply because it would flatten out here, a little bit of a trend here, a little bit of a trend there, but that was pretty much it. Um, Basically, the great move of the day. Actually, the two. If you manage to see the 1 hour low and manage to perceive that price action would not break through that 1 hour low, if you took a long position here, you could have ridden it all the way up here. So there's an 89 EMA. I have another moving average that I use, and it's multiple moving averages. And what that does is that will tell me it's a 13, a 5, and a 39 EMA. And when those moving averages will tend to cluster and cross, the market will tend to move. For example, right in this section, there was a moving average cross to the upside. The 89 EMA was pointing up, which would tend to say, "Hey, go long." I would not necessarily have taken that signal there, and I'll tell you why here in a second. I want to add another study on here, which I found is very handy, which is called Murray Math Lines. And Murray Math Lines divide price action up into octets. And that's kind of set wrong here. Let me set it a little bit differently. There we go. That's a little bit better. So Murray Math Lines tend to here. What I tend to try to do is to make Murray Math Lines delineate the market here, where it will indicate reversal overbought type of zones. Let me back that off a little bit. What I try to do is when I set up my Murray Math Lines, I try to indicate the major moves. Okay, where is that? Well, I'll adjust that. I'll adjust that Murray Math line. Take a look at that. Experience tells me that 128 square width will give the best result on the ES, and you'll see it came up almost to overbought. But if you say, for example, if you're looking at this, and I'll just crank it up a little bit more here just to show you how I like to trade this. And you could have traded this from here, from this point all the way up to resistance and beyond. Let me back off here for a second. Okay. But I'm trying to show you the structure of the market. The market's really not random, and you can see that from a lot of this. Zigzag lines. I put zigzag lines on. I'll put. I've got a study that I put together. There we are. It's my custom targets. I've got some fib extensions, or my Fibonacci price retracements configured, to where I'm looking at different levels. I'll look at different levels in the market. These are all figured, on midnight open. So I'm looking for places where the market would turn around, where the market would hit different levels. I'm going to take that off here because I'm going to use something a little bit different that I've been experimenting with for the last several months. You'll notice the theory is that the London session drives our market. So I would put a fib extension from the London high, from London low to the London high, and the reason I would do that is because the market opened here, which was above the 50% line, which is right here, for the London high, London low. So typically what will happen is it will pull back. It'll pull back to the 50% line, and then that's when it will go. That's when it'll go long. So in this particular case, you can see that it pulled back after the open. It took a while. It took almost almost an hour and a half, almost an hour to pull back. And you could have traded this. You could have you could have waited for that pullback and then gone long here. The pullback was right after the open, back here, and then once it bottomed out and went and started going back up, I would have taken that probably above that 89 EMA and then taken the trade, because you wouldn't have to, once it came up here, it came back, but it never came back to, I mean, you would have lost what, a couple of 2 or 3 ticks, which you're putting at risk less than $50 if you're trading one contract. You would be trading, you would say, for example, 4 ticks, which is $50, and then it went up north. So you can see that you could have gotten out at any time up here. I mean, just taking a few ticks off, or you could have waited for the clear method candle, the cyan candle, to go long right there. Pullback was like 2 or 3 ticks right there, and then gone. So there's multiple ways to trade this, but the market, since the market pulled back to that 50% line, when it pulls back to 50%, it usually will extend to 100% up here, and you can see that 22.50.50 was almost the top of the market. 22 in the market was up to 22.51.50 today. So it went 1 point beyond what the projection was. If it had pulled back to like 61.8 or 78.6, I'd be looking at 127 or a 161. Whoops. Or a 161.8% retracement, which would be right up in here, 22.56. But didn't pull back that far. And the analogy that I make to people is the market is like a bow and arrow. If you want to make the arrow go farther, like say for example, you want to make the arrow go farther up, then you have to pull the bow farther down. So it only came back to right around 50%. So I did not expect it to go beyond 100%. Once that point would have been reached, once it crossed above the 89 EMA, I would have probably gone long, probably on that candle right there. Suffered a little bit of a pullback, but I probably would have put my stop down here, 38.2% line. The Murray math didn't show me. That's one way you could have traded it. And then once price action went north, it never came back. So you could move your stop to break even, almost any time after that. And price came back, say for example, right there. Price came back to break even, 22.39.75 at this point, and then went north. So you would not have taken off, even if you'd put your stop to break even +2, then you would have been taken out. But if you'd have waited, then you could have made that big move up. Okay, so just looking at the market, you can see that there's a bit of structure to it. It's not totally random, and that the market tends to trade from up and down, generally speaking, respecting Murray math levels, respecting the 89 EMA. You'll notice that once price action came up here, it pulled back to the 89 EMA, and that's usually a really good entry point. And it just happened to pull back to the 23.6% fib retracement, which is a very important number. So price action came up here, it crossed. You can see it crossed the 89 EMA, crossed the 89 EMA again, it crossed here, but then it immediately came back down. So that would invalidate the long for me. It came back up here, and then it went above the 89 EMA, which signals, okay, this is probably a very good long signal. I would wait for the pullback. I wouldn't get in anywhere up here because once it pulled back down, you're going to take some heat. And you're going to sit here and sweat because you're losing money until it goes back upside. So, I would just simply wait until it came back to the 89 EMA and then go along at that point. Now, the difference between here, of course, and the difference between there and there is not a whole lot. It's just time. I would have waited. Generally speaking, that works out a lot better if you're in a trending move. So you would have maybe got in here at that cyan candle, or waited for the pullback and got in here long. There's multiple different ways that you could have traded this day. You could have even waited. Anytime in here, you had multiple entries here. If you trade the 89 EMA, multiple entries to the long side, and it was obvious that the market was going to go long. It was, you could see it even down here. At this point, after about 7:45 or so, the market was just, the general trend of the market is up. That's just, it's pretty obvious if you look at it on a higher moving average. You can see that the general trend of the market was up for the day. Even though it was very choppy, it was very trending, because yesterday was a very huge trending move. So even though the market trended higher, it still had a lot of these nasty pullbacks. So the 89 EMA is a line that I watch a lot. The Murray math levels is something I also watch a lot. I was going to replay that, but I'll do that. I'll do that on another video because I kind of wanted to show you the structure of the market as I saw it. That the market is really not as random as people would like to think it is, and that there's multiple ways to trade this. There's multiple entries. I've got friends in another trading room that I sit in that use other moving averages to get in, to generate entries, and different signals. It's kind of your, whatever your preference is, whatever you like. I've looked at this stuff for the last few months. I would have, like I said, there's the multiple moving averages right here where they would, right in here where they would cross. That would have generated a really good entry because you can see my ultra fast moving average crossed 89 EMA. My slow moving average came back and touched it, but didn't cross it, and then started going upside. So that's a really good indicator that yeah, we're going to go to the upside. 89 EMA is trending up too. So, and I think I mentioned that before. So that's a real good indicator that we're going north. Okay, well, how far are we going to go? Well, looking at the Fibonacci retracement that I drew from the London low to the London high, which acts as a projection. My 100% projection was right up here, and since I only pull back to the 50% line, I'm figuring it's going to go right around 100%. So I could have gotten a long position here at 22.39, say 22.40, for example. Anywhere in here. Say, for example, I got it along at 22.40. I rode it up from 22.40 to 22.50, and I got out. Okay. Anywhere after 22.40, right here, you might have taken a little bit of heat. You're looking at you're looking at one tick of heat right there. Just one tick. That's $12.50. It's nothing. So you're risking $12.50 at this particular point, in order to make what? In order to make 10 points on the ES, and a point is $50. That's a $500 move right there. You would have made $500 if you'd got in there and just ridden it up to that 100% line. So, and hey, what the heck? I mean, I know people that want to get every last tick out of the market, and they're looking at going here and falling up there and getting out here, and then going here and getting in here and getting out down here and that sort of thing. Another thing of the Murray math lines, you can trade that too. One of my favorite strategies is trading the market when the Murray Math level, say for example right here, and this was right around noontime, when Murray Math pulls back, when price action pulls back below support, that's support line, support 0, and then starts going back up this way, what I like to do is I like to go long at this bigger point, and that's 22.42.19. So I would set a buy limit order at 22.14, 22.42. Well, you can't set it 22.42.19. I would probably set it to like 22.42.25. And let's see. I'm going to bring that up because that should have been set to rounded tick size. So there we go. So 22.42.25. I would have gone in long. I wouldn't have gotten in an optimal position down here, but you know what? It's making money. And I watched this day after day after day right here, going long at that support, riding it up to resistance, and you get out from the top of support to the bottom of resistance, and that's at 22.50. So 22.42 to 22.50, that's an 8-point move. I mean, that's good money. 8 times 50, that's $450 right there. That's a nice move on the ES. And that would have made you $450 today on just one contract. And if you'd have traded 2 contracts, you're looking at a $900 move right there. And you get in when it dips down, you ignore the dip, and your 89 EMA is pointing up, so you know we're still in a long position. Okay, you know the market's still going up. You take the long position there, you follow it all the way up until resistance. That's where you set your target, the bottom resistance, and then in this case it would be 22.50, and you get out. And it's one trade if you want to wait, one trade of the day, and you're done. And in a trending day, that's a non-trending day. This was more of a consolidation day. Choppy. It was difficult to trade. That would have been your money move of the day. And you'll see that on Murray Math lines. And I'll do another video to just do the recap of the day, to show people, this is what happened today, and this is how I would have traded it. I was kind of under the weather a little bit this morning, so I didn't do anything this morning, but I just sat there and watched. But I was just watching price action, watching the market. One of my trading rules is, if I'm tired or if I'm sick, I don't trade, because I won't make good decisions. Anyway, I hope you enjoyed this. I hope you got something out of this guy. And this is pretty much this chart here. I have a couple more things on here. I can go over really fast. 2 more things, real quick. Let me go back to my bear chart. I add what's called a Kiwi trailing stop and zigzag lines. I'll put in my zigzags. Zigzag lines, if you'll notice, and it wasn't very helpful today just because of the chop. Zigzag lines will tell you. It will tell you tend to map out the structure of the market. I had a zigzag line that started way down here, way back over here, which was, oh God, thing's just going on and on and back. And it wound up here. And sometimes you want to, and basically that was, okay, this is kind of the top of the market. So I'm expecting a pullback. I'm expecting a short day tomorrow, just because of that. The second thing I like to put on there is called a Kiwi trailing stop. There it is, Kiwi's trailing stop. And what that does is, okay, I've got those 2 on there. My friend Pat likes to put stars on there, so I've kind of put stars on there, just so that when she looks at my chart, she knows exactly what's going on. There's my star. Okay, and then I'll put a star on this guy too. And that delineates in the market. Well, let me make this a little larger so you can tell. See how those look. Make those a little bigger, I think, today. Yeah, that's a little bit bigger. Now, the Kiwi trailing stops, what tends to happen, and the way that some people will use those is they use that as a trailing stop loss. So they'll say, okay, when price action, say for example, comes down here, when price action penetrates that, I'm getting out. Or when they have a flip, an ATR stop flip, which you'll see it flipped from this. These would be basically still keeping the long, Okay, it flipped over, which would be an indication of a short. Now that's above the 89 EMA, so I would not I wouldn't take that too seriously, especially because there's so much chop here. And all my moving averages are pointing up, and my 39 is above the 80. My 39 is above the 89 EMA. I wouldn't take that flip too seriously, and in fact, it didn't hold very long. So it was to the upside. So you'll see some people. What some people like to do is they like to hold off on their position until until price action comes to right above the ATR stop, and then they'll get into a long position here, or they'll get into a short position up here when the stop flips over. When it bottoms out is usually an especially good place to when price action will plateau here. Sometimes that's an especially good position to get in. Right here, you can see it would have been a good place to get into a long here, good place to get into a long position here, and you see the pullback to the 89 EMA. So there would be another place to to go long. So I think that does it. Anyway, I hope that this all looks, I know it looks a little bit more complicated, but I hope that it's shown you that the market is not random, that there is structure to the market. Even if you just put the Flex Renko bars on it. And somebody asked me the other day why I don't put Heiken Ashia bars on there. And the problem with Heiken Ashia bars is I don't get any, it's difficult, if not impossible, to see the tails. What happens is Heiken Ashia will smooth out the action. So that will be a solid bar instead of a candle with a tail. And that doesn't give me a whole lot of, because I don't know what's going on. Where's it closing? What's the general trend of the market? So for example, I got a long tail here, but the body is small, and it was an open, and the close was up here, and the open was down here, and I can see that. So that would generally tell me, okay, it's going to trend up. Or when you see those like that, for example, okay, we're generally trending down. And in fact, oh, by the way, I just wanted to show you this, and I'll explain it in the other video. Up to support, or up from support 0 down. Here's your long trade right there to resistance. Okay, you get out, and then you wait until price action comes to that resistance line. Okay, wait until it comes up here past the top of resistance or the middle of resistance, and then once it comes down here, okay, you get into a short position. You put your stop right there, same as you would put your stop right here at support -1. You'd put your stop at resistance +1. You get into a short position, you ride it right back down to support. And see, that would have worked out really well this afternoon. There's one move, two moves. So that's basically on the ES. With two contracts, that's an $1,800 day. If it's one contract, you're talking about making almost $1,000. Just the move up, wait till it comes down, and then move down, and then just ride it down. And you would set your stop loss there. At the midpoint, the major support resistance line, you either move your stop to break even, or you take one. If you're trading two contracts, take one contract there off there, and either move your stop to break even, or you could trail it. I wouldn't recommend trailing it, because I have seen price action, come almost all the way back up to resistance, which would take out your stop. I would have just left the stop there, break even, like break even plus 1 or break even plus 2 to cover your commission. Take one contract off at your major support resistance line and let it go down to support, just in case. Okay. With a trending day today, sometimes the market, sometimes you'll run out of, it'll run out of gas. It'll run out of time. For example, I fully expect now that this thing has come back down to support and gotten a little bit into support, pop back up. If I was holding overnight, I would have gotten into a long position down here and waited until it came back up to resistance. Now, you can see it's popped back down. I would have taken one contract off here for the long and just waited, move my stop to break even plus 2, which would have been, here would be my stop still, and price action still never came back down to it. So it's still, it's still trending up. I expect it to come back up in here and touch that resistance, which would get me out of that, which would get me out of that long trade if I was holding overnight. Otherwise, I'd have no choice to get out except to get out right up here. But that's still, still a chunk of change. It's still a nice profit. Anyway, I'm going to explain a little bit more of that in my next video, which will be in a few minutes. But I just kind of wanted to show you that price is not, it's not random. The market's not random. And I hope this has shown you that there's a little bit more structure to the market. Hey, have a great evening, and we'll see you guys tomorrow.